We're back. What up?
Coffee's so hot when you get it.
Oh, don't spill it.
Just so hot.
Sounds like an insurance problem.
What do we got today, Tone Capone?
Hey, speaking of hot, how about HELOC? The often talked about acronym that maybe nobody really understands.
Yeah, what does it even mean?
I don't know. Is it like a mythical Greek god? Like, did Homer write about this?
It's the answer.
It could be. I think what goes on with the HELOC, so home equity line of credit, that's what the actual acronym stands for. We do talk about golf here a lot. And I think what goes on is a lot of people think it's a 7-iron, easy club to swing, probably the one that most people take out for the most confident, high percentage shot.
Yeah.
And it's really maybe a 2-iron.
Okay.
A tough one. Think what
loft it.
Yeah.
Smack it down the middle.
Yeah, exactly. So what is it, right? So home equity line of credit, very self-explanatory to most people. A line of credit tied to your house, leveraged or collateralized by the equity in your home, right?
Yep, makes sense.
Things that it can do: build wealth.
It can build it.
It can do it.
It can mess you up.
It can burn it right down too.
Yeah.
Is it? I think one of the questions we had on here, right? Smart leverage or financial landmine?
Right.
Do we know?
Well, I would think it would matter how you used it, right?
That's it. So, if you just, again, treat it like a credit card tied to your house, it could probably be that landmine.
Right.
But if you are using it to maybe fuel some different opportunity or clean up some debt, that could be it. So one of the biggest appeals of it is interest only.
So you're just paying down the interest, and it's not a principal payment that's amortized. It's not taking a big chunk out of your budget.
Yep. So the most common ones of these are either 5-year interest only repayment period or 10-year. And then after you hit that 5-year window, it'll typically convert into a 15 or 20-year fully amortized mortgage. Say that, if you go to the 10-year, then it converts to like a 20-year fully amortized mortgage.
And you're saying it's tied to your home equity, so that it's got to be a better kind of a rate, right? Because it's less risky for the banks. Is that how that works?
Generally a better rate than credit cards, but certainly not a better rate than a first mortgage.
Why is that?
Because it's called the second mortgage.
So they got to get in line.
Exactly. And that's really what it comes down to. And I know that was kind of like tongue in cheek and sarcastic there, but they have the second claim to equity on your house. So
if you totally go bankrupt, they got to wait for the first mortgage company to get paid back. Then they can get
very frequently they have no rights, because when you actually go to file bankruptcy, maybe we'll get a bankruptcy person on here to talk about this at some point. You do get an exemption for a portion of the equity of your primary residence. So although it's collateralized by the equity in your house, it is a heavy bet that you are going to perform on those payments.
Makes sense.
The other reason why too, we could talk about this for a minute, because we're hearing some stuff in the news about the Federal Reserve pushing back on some banking regulations here. HELOCs, so home equity line of credit, and second mortgages, they sit on a different spot on a bank's balance sheet or a financial institution's balance sheet.
Didn't know that.
So their cost of capital is a lot higher.
Gotcha.
They have to reserve for these a little bit more.
Yeah.
And so they're looking for a return, because they have to, 1, loan the money, 2, reserve for the money. So they're taking their revenue opportunities away.
Times 2.
Yeah.
Interesting.
Yep.
So they got to charge you for
Interesting. It's interest only.
Interest. And the interest rate moves?
Yeah. So they are variable, most of them.
Okay.
HELOCs of yesteryear, home equity line of credit of yesteryear, so we'll say prior to 2021, typically tied to either LIBOR or cost of funds index. Most of these have moved to Wall Street Journal prime rate.
Okay.
You can look that up.
Prime plus blah, blah, blah.
Yeah. And we'll talk about that. So prime, though, again, a rate that you can literally type in Google, Wall Street Journal prime rate, and you'll find out that today it's 6.75%. Then that rate is going to be, again, prime plus a margin. So whatever the bank determines that margin is going to be, things that can impact that: loan to value, total loan to value, FICO score, occupancy of the property is a primary, secondary investment property. And
how much equity is left after you have the loan?
Yeah, which that falls into loan to value. We'll talk about how to calculate that in a minute, but that's where it goes. But every time prime moves, your rate is going to move.
Okay.
The other thing to understand here, there are floors and ceilings. So there is situations where the rate will never go below a certain number.
Makes sense.
And that rate will never go above a certain number.
So you get some certainty in it, but your payment might change month to month.
It could.
And probably does.
They're very frequently. Right now, we're kind of in a little bit of a static rate environment when it comes to the prime rate, but generally, it moves. And so do your your credit card rates. You just don't ever really pay attention to it.
Sure.
It's not a 30. There are, when we could talk about 30-year fixed second mortgages and some other opportunities here, but we want to talk about HELOCs today, right?
Got it.
Is it something to protect or is it something to deploy, Adam?
Your equity in your house?
Yeah.
I think that depends on your risk tolerance, to be honest with you. But I would say I would like it as an emergency fund situation.
That is one of the best uses for it. And we can, we'll run through, in my opinion, what some great uses are and what some maybe poor uses are. And then you can grill me on that. But, I think I know who you are. You would likely treat it as fuel.
Right. If I saw an opportunity.
Yes.
Yeah.
So if you have it, right, you have access to it. Okay, this opportunity popped up. Let's dump a little jet fuel in there and blow this thing up. But when you leverage, right, you're amplifying discipline or lack of discipline.
You're right.
I think as you guys have really dove into the financial side of your business now, right?
Yep.
You're starting to see that there is a very fine line between discipline and lack of discipline. And then when you take that multiplier from 2 to 10,
consequences,
major consequences. So I think the biggest misnomer here is a HELOC doesn't create wealth, the strategy that does.
Yeah. So it shouldn't fund your lifestyle. It should be on reserve in case you want to make a bet on something.
Yeah.
Or your furnace goes out and you have no more money.
Well, that's I think what we can talk about, right? So you tell me, make sense, not make sense.
Got it.
Renovations that maybe increase the value of your house.
Might make sense.
I think if you don't have cash to do it, it's probably a decent play, right?
Yeah.
Also, right, we're dealing with roofs and other little, updating and all of that stuff. So could you use those renovations to maybe reduce your insurance cost?
Could. And maybe if you're getting your house ready to sell. So I'd say yeah.
All right. That's my next one, is bridge financing or an outlet to maybe do some renovation or some prep work to get your house on the market.
Totally.
All right. Consolidating high interest debt.
Love that.
If spending stops.
Correct.
If you continue to clear out all of that, but then use your house as a credit card or an ATM.
And you're just compounding the situation.
Yep. And then you brought up earlier, right? Maybe an emergency liquidity buffer or just having it off to the side if you need to deploy it because something pops up.
Right.
You never know. Maybe when a major home repair pops up or a good opportunity, right?
Or your friend starts a plumbing business and you want to get in on it. Whatever.
Business cash flow right there.
Bingo.
So I think, right, it's a liquidity tool, not lifestyle funding.
Love that.
That makes sense.
Yeah.
So that's where, things can go wrong, right? Lifestyle creep. Now, all of a sudden I freed this money up. Can I go buy a new car?
Yeah. Or that
doesn't make sense. Well, I mean, I would buy a boat. I do. I'm not Dave. We're not Dave Ramsey over.
Buy the boat.
Yeah, that's what he said. Buy the boat and play golf, I think.
Yeah.
Income instability sometimes is a problem, right? Oh, we got to run.
Overtime.
I don't know. Let's do a little overtime. What do we got here?
I mean, I think it's smart and it's a preparation tool, right? Because you can't get this thing if you need it, right? You have to have it before you need it.
Yep. It's super easy to get too. And we can get these approved in 10 days.
That's amazing.
And if you actually need the money, we have some strategies too. We could pull these up real quick. I know we're in OT, but if we look at a situation here where someone's got about $47,000 worth of debt and we weighed out their debt and the interest rate on there, I think the APR on all of that debt somewhere in the 22% range. So if we look at prime in 6.75 and maybe we tack on
2, 3,
2, I would say 2 is probably a normal number to
like
budget
9?
in there. So yeah, somewhere in the 9 range. That's certainly, let me ask you a question. Is 9 less than 22?
Yes.
All right. So 9's less than 22. So it might make sense to do that, right? Also, we look at these repayments on minimum payment streams on credit cards. The ones that we got pulled up here, 400 months to pay off $18,000 a credit card at 18%, which is probably really
400 months, a long time.
Yeah, I didn't want to bring it up. It's almost 40 years, my friend.
Nice.
So we have some strategies like that, and then does it make sense, right? So we look at, can I keep my first mortgage at that 3% rate? You can. Now, if we blend this, right, if we look at, I have this much money owed at 3, this much money owed at 9 or 10, what is my actual interest rate? And it's very close to 6 in this scenario that we got pulled up here. So if you don't think that you can be disciplined, or you've struggled with discipline in the past, there is a situation where we can just consolidate this all into a 30-year fixed mortgage, a 25, a 20, a 15.
It gives you a nice fresh restart.
Exactly. That's the biggest thing. A restart clears the deck the back nine.
Time to make changes.
Get the hot dog, drink
Yeah,
a couple
get the glizzy.
transfusions, and you're back playing shooting under par on the back nine, right?
Bingo. Save the
Anything
round.
else?
No, rock on.
All right. You guys need HELOCs, reach out, applywithjr.com. You have questions about insurance, all the other financial situations.
AdamIsMyAgent.com. You got it.
All right, we're out.
I'm done. Cut the show.